Our goal is to obtain a reasonably stable and substantial level of earning power commensurate with the capital employed in the business. End quote. Yet again, sounds like another incredibly boring statement, but I'm convinced statements like these are exactly what we need to go from being mediocre or underperforming investors to outperforming investors year after year and becoming successful or extremely successful investors over a lifetime. Learn more about that in today's episode. Welcome to Investor in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host, and thrilled to have you with us here today. We are continuing our ongoing series going through Warren Buffett's letters to shareholders of Berkshire Hathaway. We started back in the 1965 letter a few episodes ago. Today, we're looking at 1967. And again, these first years of letters are pretty short ones, but still packed with lots of foundational ideas and thinking as we start to get into the mind of Warren Buffett as he and his team began building out Berkshire Hathaway. Again, Berkshire Hathaway started as a textile company, which we think most of us listening are probably thinking, what is a textile company? Exactly. That's what it started out as, like making working with yarns and different kinds of cloths and making materials like that. But as we have been going through these letters and as we continue to go through them, we watch the evolution of this company from a simple textile company to a massive business conglomerate that we know Berkshire Hathaway to be today. And so again, today we're going to be in the 1967 letter. I'm continuing my call to any of you out there who are musically inclined and can think of an awesome intro musically or otherwise for the show. Would love to hear from you. You can email me at Brian, Brian, at investorinthefamily.com. Would love to hear from you. Would love to hear from you about any questions you have or any thoughts you have, but especially on the music front. Again, that is not my forte and really don't care to spend a lot of time figuring that out, but would love the ideas. Because once I get some awesome music, I'm glad to add it to the show, but otherwise, I don't want to waste your time or mine. So let's jump into the 1967 letter. And that's where I get that quote from. Our goal is to obtain a reasonably stable and substantial level of earning power commensurate with the capital employed in the business. That's kind of a really official, really formal way of saying we want to have a reasonably stable and substantial level of earning power from the money we put back into the business. So basically, any money we put into this business or any other business, we want to create a stable and substantial level of earning power of return from that investment. Okay? And isn't that what we all want? Stable and substantial. If those two words could describe the earnings that I receive and you receive on a regular basis, I think we'd all be very, very happy with our investment portfolio. So again, how can we create reasonably stable and substantial level of returns, earning power, based upon the amount of money, capital we are employing in the business? So let's get into that today. So again, going through the 1967 letter is actually broken up into a few different sections, and starting out with textile, because again, textile operations were the focus in the entire makeup of Berkshire Hathaway when it was acquired by Warren Buffett. And so we're going to start with that. But as we see in the several letters going forward in the next few years, it becomes a less and less significant part of the company. So let's start with some of the negatives coming out of the textile company. So looking into the textile operations continues to be a lot of negative stuff. Sales are down. There's a sharp drop in prices of products, and sales and profits are down substantially in most of the operations on the textile side. A little bit of positive stuff. There's one sector in the textile business is doing well due to, quote, attempting to establish product lines away from areas of direct competition. So here we start getting the idea of a moat. And even early on in as far as how he's running the overall textile operations of Berkshire Hathaway, looking for ways that how can we establish product lines away from areas of direct competition. So even in the textile industry, which is struggling, it's cyclically, the whole industry is down at this stage in the business. Sales are down, prices are dropping, and sales and profits overall are down substantially, except for the one sector that's doing well because they're trying to establish product lines away from areas of direct competition. And for any of you who have studied Buffett much before, I know that this is a big part of his investing philosophy is how can we find businesses that have a moat. And you can describe a moat probably in different ways, but I know this is an important aspect of it. What is a company that kind of doesn't have a monopoly, but almost has some kind of a monopoly, kind of like Peter Thiel talks about in the book 0 to 1. How can you find a small sector or product line or something that you can have a monopoly of? You can monopolize this product or this segment of the market and then expand out from that. And you see kind of an idea like that here in a sector that's struggling overall. The one sector of their textile business that's doing well is one that they've been able to focus on areas where there isn't direct competition. So again, as we're thinking about investments, as we're thinking about starting businesses of our own or acquiring businesses or purchasing businesses, even if that means buying stocks on the stock market, that's still purchasing a business. And I want that to continue to be a part of reshaping our mindset toward investing. If you buy one stock of one company on the stock market, I believe we should have the mindset that we have just bought that company, and we should approach it with that same level of due diligence and seriousness. So when doing so, this idea of having some kind of a moat or product or business that's away from direct competition is a really healthy thing to focus on and to be a kind of factor in as we're making investments. So I want to jump past some of the textile stuff. Let me see. Or maybe actually still in some of the textile things here a little bit. But I want to talk about, still in textile a little bit. He says, and again, I'm using the Max Olson book of the Berkshire Hathaway Letters to Shareholders, 1965 to 2014. So if I ever refer to page numbers or something like that, I'm probably going to try to avoid that a little bit, but it helps organize my mind. And if you don't have the book, just ignore the page numbers. But if you do, you can follow along with me. So again, page 8, paragraph 1, and I'm using the page numbers for the books, not the letters themselves. So at the top, he says, although product development and diversification of fabrics will result in higher manufacturing costs, these higher costs should more than offset by higher prices for the fabrics and results in greater profits. So again, the idea he's saying here is, it's like, although the product development and diversification of fabrics may result in higher manufacturing costs. So this new venture or this new product line or this new undertaking in the textile industry of Berkshire Hathaway may result in higher manufacturing costs, but those costs should be more than offset by higher prices for the fabrics and results in greater profits. So it may cost more to do what they're trying to do in this new product line, these new ideas, but they can expect greater profits in the future to offset those costs. So again, that sounds basic and obvious. If you're going to make more money off of it, it's okay to spend more money on it. But I want us to think about this from being in the seat of the business owner, because we are business owners. And again, like I've described in previous episodes, the mindset that I want to develop for myself and I'm trying to develop in those of you following the Invest in the Family Business in this podcast is our households are a business. And we shouldn't view our household, quote unquote, personal finances as seriously as we would the corporate finances of a business that we may be running. And so of our household, of our business, what are the, thinking of the overall balance sheet of our business, the income statement and cash flow statements of our business, and are there opportunities where maybe it may take a higher upfront cost of an investment in some kind of a potential revenue stream for our household or our business? Is there something like that where we can invest some money that may be intimidating right now and maybe require kind of higher costs or higher expenses right now that should lead to higher income and higher profits down the road? If so, perhaps that's something worth considering. And one of the ideas that I continue wanting to develop out as we're going through these letters and as we're going down this road of building our own personal Berkshire Hathaway, again, and our Berkshire Hathaway is our household. And obviously, I'm sure you're not going to call it Berkshire Hathaway, but maybe give a name to the business of your household, even if it's just something you use internally or you just think of yourself. But if it helps you have in the mindset of building your own personal Berkshire Hathaway, which is your business, which is your household. So the thing is, you already have a business. It is your household. How are you managing it? And so as we're thinking about what are the income streams, what are the cash flows, and one of the things I want to start developing the ideas of putting money in the stock market is not our only avenue of investment. And so commonly, like the most popular avenues of investment that we hear about are the public stock market. If you're feeling a little more risky, maybe real estate, whether it actually is more risky or not, isn't the question, but it feels like a bigger deal. Real estate is a big option or something that's talked about a lot for investors. But really, those are usually the two primary options that are out there. And I think there is a lot of merit and a lot of reason to look at both those options. Those are both very serious options for me. And two investment streams that I want to develop myself. But another one is the idea of being entrepreneurial. And obviously that gets tons of press out there, but it's not often thought of in my mind as part of our investing household. As far as our business or our household finances, is there another product line or another business, another supplemental business, a quote unquote side hustle? I don't like that phrase, but some people, you know what I mean when I say that. Is there some kind of supplemental income stream that can be developed that may require some upfront cost, maybe some upfront training, or otherwise that isn't maybe intimidating at first? Maybe it costs hundreds of dollars or a couple $1,000s to get started. But if we do our research, we do our due diligence and do the right work, it could easily have a very quick return on investment and be an ongoing income stream into the future. If so, perhaps that's something we should consider. And again, I will be talking about that idea more and more because I do believe for a lot of us should increasingly become a very significant consideration for us. Because as we think about our business and the investment side of our business is the idea of wanting to allocate capital well. And so as we have, and most of us, our primary income stream will be our full-time jobs, our employment. And so from that is a primary means of acquiring capital. And then once we pay our expenses, and then once we have a healthy savings fund or emergency savings fund in place, anything beyond that becomes excess capital that we get to allocate. And so where do we want to allocate that capital in order to get the highest possible returns in the future? And will that be the stock market? Will that be real estate investing? Will that be commodities, gold or silver? Will that be some kind of an entrepreneurial venture? Because the benefits of an entrepreneurial venture, if done correctly and if done well, is that they can create healthy streams of ongoing, stable and substantial levels of cash flow into your business or your household. And that cash flow then becomes extra money. Extra capital you can allocate back into your business or into other businesses. Because the idea is we want to allocate our capital wherever it will provide us the most stable and substantial level of ongoing return on capital. And if that means continuing to invest it into our household to create new streams of income, then awesome. If that means investing in ourselves to create, to make us more valuable to our workplace, that can lead toward promotion or raises, then maybe that's an option. Or maybe we look at our household and realize right now there are no current ways or really great options to increase get a return on investment internally. And so we look externally for opportunities to allocate our capital that can return the greatest, that can provide the greatest return on investment externally from our household. And that's where we think of common stocks, or potentially other options, which we'll get into as well. But again, we're shaping the mindset here. We're shaping the mindset of how we manage our household and how we build our own personal Berkshire Hathaway. So moving on down the letter, now on page 8, paragraph 4, again, ignore this if you don't have the book, but it's helpful for me. So here we have a situation where Berkshire Hathaway has a sector of their textile industry that is continuing to perform on a very unsatisfactory level. And so you have this question of like, what do we do with this? We have a sector, we've already invested money into it, it's underperforming. Do you invest more money to improve it? Can you fix it? Or do you just cut it? And so how do they approach that? Well, what they did was they conducted research, they did surveys, they looked at the market, but eventually, and then obviously looked internally at that sector of their business, and eventually made a very tough decision to close what was actually a quality plant, but bottom line is there's lack of demand for the product. So what do you do when you have an investment or a business or an income stream that you've invested money in that is actually performing really, really well, but there's no demand for it? So it's performing well in terms of internally it's efficient, it's operating well, maybe it's even managed well, but if there isn't a demand for their product, what do you do? And so what they did is they conducted research and they realized ultimately that they had to make a change. Ultimately they needed to close down the plant. Those are tough business decisions. And so what does that mean for us? Okay, so you don't own a big textile company and maybe your household is still just your household. You haven't expanded in other ventures, but you are in the stock market. And so you have investments in stocks. What happens when you have investments that aren't performing? Now, I think for a lot of us, probably the biggest problem is not giving our investments enough time to materialize. We probably cut investments too quickly. But this factors in there as well. When you have investments that aren't performing like you want them to do, what do you do about it? What they didn't do at Berkshire Hathaway here is say, hey, it's unsatisfactory. I'm cutting and I'm going to start something else. But that is how I think most of us view our stock investments. We buy the stock with probably a lot of optimism. We're excited about its potential. We're overly optimistic, probably in a lot of cases. But either way, we all know how the story goes. We're checking our portfolio probably way too often, whether it be daily or weekly or monthly or whatever that is. Again, I'm a big advocate in not checking our portfolios very often at all. But we look at that stock, we're excited about what's going to happen. Then weeks go by, months go by, nothing, or it's falling. And we start thinking, oh no, I've made a big mistake. I'm losing money, and we can panic or sell out. But that's not what Warren Buffett did. And that's not what Berkshire Hathaway did with this sector. They did surveys, they did analysis to go back to look at the sector and figure out how is it performing and what needs to happen. And so when we have stocks or investments or any other income streams that aren't performing, we want to go back and we want to evaluate them objectively. We want to look at why do we buy it in the first place? Why is it underperforming? Is this temporary? Is it ongoing? Can it turn around? Can we make a change that can then improve this investment in the future or opportunity in the future? Or do we just need to cut our losses? Because sometimes we do. And so I wanted to bring that out because, again, as we're going through this, I want to learn how did Warren Buffett run his business? And so then how can we in turn run our business as well? And I also want to bring up an idea here too that I want to be really careful with, because with most of us, if our primary or only means of acquiring new capital is our jobs, basically our only income stream is our job, obviously we're very sensitive to our jobs, because if you lose that job, what happens? And there may be no backup. What we want to begin doing is creating alternate streams of income, because when Berkshire Hathaway started, it was just a textile company. But over time and over several years, not right away, we're going through these letters at this point 1 week at a time. So it feels like things are happening quickly, but they're not. Where each one of these letters has 1 full year in between them. Okay, don't forget that. So with Berkshire Hathaway, they started as a textile company, had one main focus of operations, just like most of us have one main focus of operations, which is our full-time jobs. But over time, you start seeing them bringing in new revenue streams. And so what I want us to start just thinking about, and eventually the textile portion of the company, I'm pretty sure it goes away entirely. We're not to that point yet, so I don't want to jump the gun. But you can see even in the next few letters, as I've read ahead a little bit, it becomes a less and less significant part of overall Berkshire Hathaway holdings. And I would love for us to get to that point as well, where our full-time jobs, we may want to keep them forever. I love my full-time job, but some of you may as well, but some of you may not. But what about having the option to maybe not be at least as dependent upon it? Maybe you keep it forever, and that's great. But so I want to think about, are we a slave to our jobs? What are we a slave to financially? Are we a slave to our job, thinking, well, I can't touch this, I can't mess with this because this is my bread and butter? And again, maybe it is, and maybe that's great. But having the mindset of, well, maybe that can change in a few years. And just kind of having that approach and mindset that, maybe a change should happen. Maybe there should be a change in years to come. Maybe you can start laying a foundation now that can allow you to make a change in 3 years, 4 years, or 5 years. So again, planting seeds of thinking, viewing our household as a business here. And just in general, what do you need to cut and stop throwing money into? And so, we can think of this as forming a budget for our households. Again, that sounds boring. Most investors don't want to think about the personal finance side or savings. We want to think about investing and making more money. But again, that's why I say a lot of times, or open this podcast with statements that sound really boring. but are foundational to having a successful business or a financially successful household and building our own personal Berkshire Hathaways. If we don't lay our foundations well, we can't expect to be great investors also. Because if we can't run our own business well, why on earth do we think we can assess the merit of someone else's business? So, and make an objective and quality investment in that business. So we need budgets. We need to form a budget for our businesses, for our households. I know that sounds like, I don't like doing that. I don't want to do that myself. But we form a budget and we're disciplined to maintain that budget. We figure out, what do we need to cut? Where are we spending money that we don't need to spend money? What expenses can we cut? What can we stop throwing money into as a means of generating more capital or maintaining more capital, keep more capital in our business, in our household that we can then deploy or allocate most effectively to create the most stable and substantial levels of ongoing earnings power or growth into the future. Okay. And so let's jump over into a later section of the letter where he's focusing on the insurance subsidiaries, because remember, they acquired an insurance company or some insurance companies, and they've been performing really well. And so we start getting a little bit back into the broader investment philosophies of Berkshire Hathaway. Again, they realized, so we have this textile company, we have these assets, our capital to allocate, and they realized we can make more money and get a greater return on this capital by investing it in these insurance companies and not back into the textile companies. And then down in paragraph 6, Buffett makes the comment about, he says, all earnings of the insurance subsidiaries, which by the way, he talks about, the insurance subsidiaries are performing really well, really pleased with how they're doing. He says, all earnings of the insurance subsidiaries are being retained to build additional capital strength. So again, as they're making money off these insurance companies, they're not thinking, how can we invest it right away? And they're not thinking of how can we spend it right away, but they're sitting on it and waiting for more opportunities. So again, it's okay to have cash in our portfolios. And when we make new money or we put more cash into our portfolios, it's okay to be patient. It's okay to wait weeks, months, maybe longer as we wait for the right opportunities. Because here they've got insurance companies that they're profitable, they're performing well, they're bringing money into the company, and they're sitting on the money and waiting because they're building additional capital strength, so they'll be poised and ready to make new acquisitions or new moves when the right opportunities develop, which again, I love and am such a huge fan of. And then I want to read, I think it's paragraph 7, the next paragraph, the bottom one down on page 8, because I just want to read this paragraph because I feel like it really helps it again gets back into the mind of where Buffett is in the long-term picture of Berkshire Hathaway. It says, our investment in the insurance companies reflects a first major step in our efforts to achieve a more diversified base of earning power. I am so excited to hear about your first major steps like the one Warren Buffett is taking here. And again, it may be small. Maybe it's a small step in terms of trying to create an additional income stream or a shift in your investing philosophy. But I'm excited to hear back from you and hear about what you describe as being your first major step in your effort to achieve a more diversified base of earning power. I love the way you phrase that, and I'm excited for us to do the same. So back to the paragraph. The success of this effort is indicated by the attainment of earnings in the subsidiaries during 1967, which substantially exceeded the earnings attributable to a larger capital investment in the textile business. Again, if they would have put that capital investment in the textile business, it would have had nowhere near the return that it did have by investing that capital in their insurance subsidiaries. So again, having the mindset, where can we allocate our capital? And any money we have is capital we have to allocate. And so we may think of allocating capital to going out to eat for dinner. That's allocating capital. And that's a fine way to do that if it's giving you the return you want on that investment. Because every dollar we spend is an investment in something. Every minute we spend is an investment in something. Back to the paragraph. We expect that there will be years in the future when the order of relative profitability is reversed. So he's already predicting the time when the textile operations of the business will become a less and less significant part of the company, and other sectors like the insurance or those yet to be acquired as of 1967 will become a greater and greater part of Berkshire Hathaway. Reflecting different stages in both the insurance and textile cycles. However, We believe it is an added factor of strength to have these two unrelated sources of earnings rather than to be solely exposed to the conditions of one industry as heretofore. How do you like that? Heretofore. When's the last time you used that word? Okay. So here you see them talking about Berkshire Hathaway's first real move toward diversification. They have textiles and they're diversifying out into insurance. Two completely unrelated industries. But again, remember, this was a slow process. We started this in 65, or the letters, and then 66, 67 is when they're talking about having these insurance companies. And again, this is in 67. So again, he bought the Berkshire Hathaway, which is a purely textile company, in 65. Then you have 66. Then in 67, around 2 years or so later on, they purchased these insurance companies. And so you see, this takes time. So right now we're listening to these podcasts 1 week at a time. At this point, we're going one letter per week. So each week we're having a new letter in this podcast. But remember, each letter is 1 year apart. And so that's a lot of time for things to happen. And so I want to continue to encourage us to be patient. Some of the most significant things for us as investments are arguably all of or at least most of the significant investments we make or things we do like this. It will take time. It'll take time for us to get to a position to make the investments or to start a new income stream or to start a new side business or things like that. It takes time, and that's okay. It took them over 2 years to get to the point where they made their first significant acquisition of the insurance companies. And so now they're diversified in textiles and insurance. So again, two very diverse, non-correlated assets, essentially. And so again, this is a slow process. So think about this. Could you research and add one company per year to your Berkshire Hathaway? And again, that could mean public stocks as well. So think about this as stocks as well. So what if so I know a lot of the feedback I get is how much everyone struggles with not having enough time to invest and to research and do things. I completely understand that. I face those same struggles as well. But what if we had the mindset of acquiring one company per year or two companies per year? I think all of us could do the proper due diligence and research to add one new stock to our portfolio a year. And right now you're thinking, that's insane. Well, that's how they're doing it. Buffett and Berkshire, they did put excess capital into the stock market. They don't spend much time talking about that in these letters, because I'm sure, and so we don't know exactly what stocks he was investing in at that time with those. But in my mind, for us, I view that as, putting some money in an index fund while we're waiting for the opportunity to allocate that capital. So that could mean having 100% of our money in some passive index ETFs, the S&P, could be SPY or something like that. And then over time, doing research. And we'll talk about research methodologies in another time, but doing research and looking for what are some really amazing opportunities. Where's an amazing opportunity? What is a really long-term amazing opportunity that we can invest in and find one great opportunity a year, or maybe two, which I think is very reasonable for us to do. And then the next year, focus on finding another one. Because here's the deal. If we're looking to find an investment that's going to return 100x return, so it's going to basically grow 100 times the initial investment, and so which sounds amazing, we call that a 100 bagger, okay, which sounds amazing and all that kind of stuff. But most of the companies that have done that, it takes decades for that to happen. But that's okay, because if you put $10,000 into 100 bagger, and it maybe takes 3 decades to materialize. In 3 decades, that 10 grand becomes $1 million. So you really don't need that many of those to work out in order to be really, have a really profitable enterprise. And so again, that's something we can elaborate more in other scenarios or other episodes, but I want us to have that mindset and to think about that. So if we can add one of those per year, think about that over time. That's a really substantial idea. And that's the pace that Berkshire Hathaway is taking. Or what if you can add one new revenue stream every 2 or 3 years? Right now, that may sound maddeningly slow, but that's what successful investing is. Think about a tree. Again, I've talked about this before, and I'm sure I'll talk about it over and over and over again, because I want the mindset to permeate our thinking. When we bought our house, we had this amazing red oak tree in the front yard. It's one of those scenarios where you basically buy the tree and the house comes with it type thing. And then after a year or two, there was a big storm, and there ended up being some unhealthy rotting going on in the tree we weren't aware of, and we lost the tree. It was terrible. Since then, we planted a new tree, thankful for it, excited about it. It's healthy and it's growing, but it's going to take decades for this new tree to get where that old tree was. And that's so hard to think about, but that's why planting trees is so amazing, because we're planting trees for the future. I'm planting a tree so that either in the future, my family or another family can enjoy the shade of that tree. And I want us to view every one of our investments that way as well. We're making investments today so that in the future, we or our families can enjoy the shade of that tree. And they can look back on us at this time, or we can look back on ourselves in the past and think, I am so thankful that I was disciplined enough and worked hard enough to plant trees and plant seeds back then that I can enjoy now. Because if we're having this fast forward mindset of, I want it now, I want great returns now, I want this investment to double this year or return 50% this year, it's great if all those things happen. And I think we'll probably be surprised that those things may happen more often than we think. But we don't know. We don't know what's going to happen with those things, but we can plant seeds that over time can have a very consistent return. They can turn into amazing trees and oak trees in the future. Okay. I want to read the last paragraph of this letter. It talks about how management continues to be alert to new opportunities for capital allocation. And so here he goes. He goes, management continues to be alert to opportunities to expand our operations in either the textile business, the insurance business, or an unrelated area. Again, as we have capital to allocate, we continue to have the mindset, where can we allocate this capital or invest this money to get the most stable and substantial return possible on our investment? That could be in our current household. It could be in a new income stream. It could be in the stock market, real estate, or other areas like that. Back to the paragraph. We feel it is essential that we not repeat the history of 1956 to the 66 period, where overall earnings on average invested capital of over $30 million were something less than zero. So basically, from 56 to 66, they invested $30 million of capital back into the textile company and basically saw zero return because of that. So let's pause there. Right now, you may be thinking, I know that probably at least half of us listening right now are very unsatisfied with our portfolios at this point in time, and all of us have made mistakes. Right here, we're reading from 56 to 66, Berkshire Hathaway. This is the pre-Buffett era, but still, they invested $30 million into the company and saw almost no return on it. Everyone makes mistakes. We all have a history that we'd like to improve upon. Don't let the mistakes of your investing past. First of all, don't miss the opportunity to learn from those lessons, but don't let those define your future. Okay. Except for the fact that you're learning from and not wanting to repeat those mistakes. And so Berkshire is having the same idea. Okay, we did really bad for 10 or 11 years. We're not going to repeat those same mistakes. Back to the paragraph. Our present liquid resources held in readily marketable common stocks are available for either acquisition of new businesses or for application toward greater profit opportunities in our present operations. In addition, we will not hesitate to borrow money to take advantage of attractive opportunities. Our goal, double, triple underline, is to obtain a reasonably stable and substantial level of earnings power commensurate with the capital employed in the business. Again, the whole idea is how can we increase the capital inflow into the company, and then how can we wisely reallocate that capital to create stable and substantial levels of earnings power return in the future. Okay. That's the idea. That's the system. That's our business philosophy. And that's what we're doing. And those opportunities can be investing in training to improve our opportunities for a raise or a promotion in our current jobs. It can mean getting training or creating other side income in addition to our main job. It can mean investing. It can mean real estate properties and residual income from that way. It could mean investing money in the stock market. All these are avenues. And again, everyone, we're making our own investing decisions, and I don't want anyone to make a decision you're not comfortable with, but I wanted to expand our ideas of what it means to manage and build our own personal Berkshire Hathaways. So that is the 1967 letter to shareholders of Berkshire Hathaway, written by Warren Buffett. Another great letter. I'm stoked about this. Every week I read one of these letters and I am just seeing my philosophy of business building and investment being shaped more deeply. And I'm stoked about it. Hope you are too. Can't wait to hear from you. Shoot me an email, Brian, Brian, at investorinthefamily.com. We'd love to hear your thoughts on what's going on and catch up. But until next week, this is Brian, and thanks for joining the family. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.